Thanks for coming out this afternoon for our panel on ESG and sustainable investment. I'm the sustainable finance editor here at Bloomberg, and we've been covering sustainability and ESG for the past 4 years and just seen the space explode, right? There's over 30 trillion in assets that are some sort of criteria for ESG today. So we have a wonderful panel here, and they're going to get you all excited about what they're doing and how they're rethinking investment. Let's start with a poll. Can the poll come up? Everybody get your poll things ready to go? So our question is, how do you define your approach to ESG and impact investing if you have one? And here's the questions. It adds value. It's important to advocate for social and environmental issues. Or I'm indifferent for now, and I'll see if I dip my toe in the water. While we're waiting, maybe we can ask the panelists, have you dipped your toe in the water, Daniel?
A long time ago, yes.
And how do you see it evolving, the space from Credit Suisse?
I think the exciting time we are living in is proof that many developments come together right now, positive developments. So many motivations are true and are important. One important one is that we, I think, as human beings have realized that if we want to have long-term attractive returns, we have to protect our social resources and our environmental resources as well. And for larger asset owners, this is a big motivation to consider ESG investment decisions. But then there is also a lot more evidence on the performance side. 20 years back, it was difficult to prove that you would not harm current performance. I think by now there are enough studies out there, also meta-studies looking into hundreds or thousands of underlying studies that prove that there is at least no negative impact, no negative performance impact. And then the third important trend, I think, is really the active interest from individuals, of family offices, high net worth individuals, which would like to leave something on the planet, not just protect their capital, but also have a positive impact on society. And these all merges and leads to this super trend, if you want, which we are seeing now.
Yeah, that's a great response. And it's really interesting to see how the panel shaped up here. That we asked a similar question in New York last week, and we also had over 50% for the second answer, that it's important to advocate for social or environmental issues. And this has actually really changed. We've been asking similar questions for years at Bloomberg events, and it hasn't been so from people's heart that they say this is important to do. How do you guys value ESG? Claudia, I'll start with you.
Yeah, so our clients, so we invest over 500 billion on behalf of Dutch pension funds, and they are very clear that it is about providing affordable pensions so that the pensioners can retire into a livable world or a sustainable world. So that dimension is there, but of course the fiduciary duty is to provide risk-adjusted returns that can actually create that pension. So it's both the contribution to the performance and the returns, while also really investing, for example, into the energy transition. And we have found that you can find very well-performing and very sustainable investments if you look for it.
Great. Yeah, we've seen the space really grow up recently. We have a chart, I think, from Bloomberg data on ETFs. ESG ETFs have, I guess in the first 6 months of this year, they have seen record inflows. It's a big year for ESG. Investors put $4.1 billion into at least US ESG ETFs. Similar ETFs are launching all over Europe. Are you invested in that in the church, or how are you investing and choosing which asset class to go for?
Okay, we don't invest in ESG ETFs, actually, rather in contrast to the panel we had earlier, which was talking active versus passive. We tend to be more contrarian investors and actually feel that the environment for active management now is really very favorable. I know that goes completely contrary to the trend, but we think when you've had an environment of massive growth in passive, actually the environment for active is going to be better. So we really look to partner with what we would describe as the best-in-class managers globally, who very much take ESG. ESG is very much at the heart of their process. And going back to the poll, obviously we're the church. I mean, we've always been doing ESG, so for us it's just fantastic to see this explosion. It's actually why we're investing more resources in our engagement team, etc., because we really feel now, with everyone else getting on board, that the opportunity to actually generate change is really really transforming, which is important. So it's great to see the growth in ESG ETFs, because it gives more choice for consumers. It gives more choice for investors to invest in, which we really like to see. But given how we see the world, currently we're preferring to retain a very active approach to our investment management with partners who very much take ESG into consideration in terms of their investment process.
Daniel, at Credit Suisse, how are you seeing asset flows across different types of assets, active, passive, credit?
We see the demand from different sides, and I would not necessarily say that the decision to integrate more ESG is linked to a certain asset class. And that's also a little bit how we look at it. We think we want to mobilize capital across asset classes, because that's also needed to support the Sustainable Development Goals, which count on $2.5 trillion from the private sector. In order to reach that, we can not only do ESG or impact investing in illiquid asset classes, very specialized, high conviction approaches. We have to make sure we can do that in all the asset classes our clients also ask for. So we try to offer solutions in actively managed strategies, equities, bonds, in passively managed strategies, quant-based strategies, which also means it's not one size fits all. There's not one right or wrong way how to integrate ESG in these asset classes. You have to find the best possible way to profit from the ESG-linked opportunities and risks to take the best out of it for your investment objective.
Claudia, you guys have a full portfolio approach for its ESG, but are you going into these individual ESG products?
Yeah, we are not really focused on products either. So we have this total portfolio approach. And then, of course, within different strategies, you would find different approaches. But one focus, perhaps, that is for us very explicit is about investing in solutions to the Sustainable Development Goals. So it's about an active contribution, and it's really about the products and services, about the core business of companies and also in private markets that we want to invest in, rather than focusing on sort of more technical aspects of risk mitigations or the like. So it's really, likewise, like you, we have a very active investment management approach, majority in-house, that allows us to make a very active selection on the kind of investments we want.
Yeah. Just to make one further point, actually, where we will potentially make use of ESG ETFs, etc., is that we're feeling that we're entering into a world that is becoming more volatile, and actually the quantification of the market, the market structures where there's lack of liquidity, etc., is leading to much more sudden gap risk and much more sudden moves in markets. That for a contrarian investor is creating opportunity, and what we're thinking of doing is utilizing passive product to, when we see those opportunities, to get into the market quickly, and then we will roll those funds into our active managers, because it's sometimes difficult. Sometimes some of our managers are closed. Many of our managers are closed. They won't take more capital, for example. So the development, obviously, for an investor like the church that will exclude certain companies, exclude certain sectors, but deliver in a passive strategy, does have a role that we are looking at, and we find that it may provide more use in what we expect to be a more volatile environment going forward.
Yeah, that's really interesting. I've heard similar comments about ESG money market funds this year, where people say, oh, I can put my money there now and sort of wait and see what happens until I need it. I wanted to follow up with you, Claudia, about solutions. Are there any examples that you're really excited about?
Yeah, for example, we've been investing into companies that provide affordable housing. Then, of course, been investing a lot into the energy transition, but also into bioplastics and anything that really is more forward-looking. And we've been, so our client ABP set a target of having 58 billion invested into the SDGs by 2020, which was a small challenge for us in 2015. And since then, we have, together with other asset owners, developed an approach and a definition of what is it, then a taxonomy, and now we have just announced our intention, together with PGGM, the other large Dutch fiduciary manager, to establish an asset owner platform around the SDGs. What does it mean to be investing into the SDGs, and to provide a standardized approach that we would really hope that other institutional investors who are interested in generating better disclosure and having a more common voice when engaging with companies and being able to have a different perspective when analyzing their companies would consider joining us.
Yeah, at the United Nations this past month, there was a lot of talk about SDGs being sort of the next wave of sustainable finance, and probably a lot more SDG-linked products coming out there. So one of the major activities of ESG investors, I think, is to actually engage companies and try and have an impact. And I think Tom from the church is one of those investors that's had a real impact. Could we go to one of our charts on Exxon? Maybe. There it is. So this is a really interesting moment in the market just the past few months, where Exxon's weight in the S&P 500 dropped to 1%, down from 5% in 2009. It's the 12th largest stock in the index now. It shows sort of how the ground is shifting in energy. We've said that, I think from Bloomberg New Energy Finance, my colleagues found the world will invest about $2 trillion in new electrical capacity from fossil fuels, but $11 trillion in zero carbon technologies. And so this is a huge transition. That's over the next 30 years, those numbers. And Tom, how are you pressuring companies to get on board with that?
Well, yeah, I mean, I guess at the heart, we do believe that engagement is important. We do very much believe as an owner of assets, you should be an active owner and you should engage with companies. We also engage with asset managers to try to get good change. It's well publicized that Exxon is a company that we are engaging with. I have to say it's sort of frustrating, the progress there. That's probably an understatement, but we will keep trying, thinking of new ways. And what I would say is, and this comes back to your poll and what I said earlier, is it's never really felt like a moment. Before we've always done engagement, but now we really feel that others are willing to work together, and asset managers and asset owners have never been so well aligned. I think Claudia's going to talk about Climate 100 plus, etc. Investors and asset owners are really well positioned and well organised to try to effect that change, because we're just an £8 billion fund. I actually like the small size. It means I'm more nimble and we can do more interesting investments, etc. But when it comes to being confident about getting change at companies, etc., while our voice is often listened to and respected, and we get very good access, it's really only when we get other investors on board and other investors aligned with us that we get change. So the shareholder motion that was passed in 2017, which is forcing Exxon to do more analysis about the impact on its business, in a 2-degree world, etc. That was, BlackRock and Vanguard, supported us in that. These are huge asset managers, etc. So it's that real change that I think is really important and fantastic to see. I mean, if you go back in time, in 2009 when I joined the Church Commissioners, for example, Legal & General wasn't even a member of UNPRI. Last year they co-filed a shareholder resolution with BP. In 2014, Vanguard joined UNPRI, and they supported our resolution in 2017. So it used to be that if you're a passive manager, you didn't have to be an active owner, and I just think you don't have to be an active manager to be an active owner of your assets. And I think that change is really allowing effective change, corporate change. But it's fair to say that it's harder work with some of the US oil and gas companies compared to the European oil and gas companies, where we've really seen some quite dramatic change. We need to do more, though. Right.
Claudia, what are you doing with the Climate Action 100 group?
Yeah, I first want to say this has been really trailblazing work, so all credit. And so Climate Action 100 is a group of 370 global investors who have more than 32 trillion US dollars of assets under management. And collectively, they are engaging with the highest emitting companies in the world. And we've seen some real successes. One of the most recent ones is Shell, who has committed to ambitious climate targets and also linking those to remuneration. And Ben van Beuren, actually the CEO, he was at the PRI, the Principle for Responsible Investment Conference, and in conversation with the Church of England and also with Robeco, one of the other leading companies. And we are in the lead for the food sector and have been, together with other investors, engaging with Unilever and Nestle And Nestle, for example, has recently published an agreement that they're going to be completely climate neutral by 2050. So it really shows that collectively we can make a difference if we're active owners. And we strongly believe in that at all levels.
Yeah, it's really interesting to see how investors are getting a lot of movement this year, especially I've seen on linking pay to sustainability performance. I think we have about 500 companies globally that Bloomberg tracks that are linking pay to some sort of ESG metric. But also we've seen that carry over into the markets, right, into the credit markets where there's all these new sustainability-linked loans and green bonds and products. We have another chart on green bonds issuance, which is up significantly this year. We've already reached 184 billion in green bonds. That's 70% of 2018's total, or 184 billion, sorry, in sustainable financing, and 123 billion of that is just green bonds, which we have up on our screen here. But yeah, tell us what you're seeing, Daniel, in terms of financing and making that more sustainable.
Yeah, well, green bonds is of course a good example to have something very focused. I think the market is now at 600 billion or something, but it also means that the universe for green bonds is relatively limited because there is quite strict rules that apply. So we see some high quality issuers, of course. They are often linked to governments indirectly or directly, and it's often focused on two sectors. It's utilities, it's the financial sector, and we see a lot of client demand also to broaden that universe. Now, that doesn't mean we want to weaken the green bond principles, but we have engaged actually with the climate bond organization to have transition bonds issued as well, which should be issued to help investors have access to other industries as well, maybe to companies which do not qualify for green bonds, but also have an important contribution to provide on the way to a low carbon society, or even addressing any other sustainable development goals, topics. So that could be waste, that could be health, that could be packaging. And we intend to formulate very clear rules for these transition bonds as well, so we can broaden the market a bit from that perspective.
When you look at your overall lending portfolio, how big a role do you think things like transition bonds and sustainability-linked loans will play?
I think there is big demand for that because also the investor and asset owners would like to cover these topics and would like to report on these topics and see what they have done and what contribution they were able to provide.
As asset owners over here, are you guys big buyers of green bonds and these loans?
Well, I mean, I agree with everything that Daniel said, but then I'm going to say that actually we don't pretty much invest in fixed income at all at current prices. We heard in one of the earlier panels the real challenge for a sort of 60-40 portfolio and any sort of sensible expected return that would give you. It's a real challenge for an asset owner. Our biggest issue is inflation, protecting the real value of our portfolio through time, and at negative yields, at really investment grade yields below inflation, etc. The whole fixed income suite is offering such poor prospective returns that we're really not investing in it at all at current prices, because we have our target return is CPIH +4. That's an ambitious long-term target, but we're a long-term investor. We can stomach short-term volatility. So at the minute we're not at all. But if prices change, we definitely think they're a good thing. And if the fixed income market reprices to something more sensible, we'll be active players again.
We at the end of last year, we had about 6.9 billion invested in green and sustainable bonds, sort of 104 instruments, and that compares to 1 billion in 2015 and about 38 instruments. So we've seen a tremendous growth, and also where the pricing is, comparably good enough, as in we wouldn't make any concessions. And the most recent one is now Enel has issued the first SDG-linked bond, and we got our full subscription. And I think that's a really interesting example where their renewable energy capacity is currently at 49%, and they've set a target to have it at 55% by the end of 2021. And if they don't meet that target, investors will get an additional 0.25% of interest. So that's
it only punishes them if they don't reach their goal.
Exactly. So I think that's an interesting model. And it's also was for us interesting to see during the issuance process that companies really value long-term investors who have very strong sustainability or sustainable investment credentials in terms of engaging of how to structure an instrument, etc.
Yeah, I think I've heard there's a lot of demand for that type of product to come to market more and more SDG. I guess the SDGs are a wider type of things you could cover than just a green bond.
Yeah, and of course, we have also very deliberately not invested into something that was named by name green bond, but really there was no substance to it. So we're quite critical about that, and really that sort of rigor of standards has to be maintained. And we've also seen the Irish state issuing bonds linked to sustainable waste and water management, and the Belgian state also to wind farms and fast rail. So those type of instruments we've also invested, and provided that the investment profile is right, we like those kind of issuances.
So one of the big issues here across ESG and impact is how do you measure that you're actually having an impact? Everybody's used to financial returns and what that looks like, and obviously sometimes revenue is linked to ESG goals if you're a renewable power company or a recycling company. But how do you measure you're having an impact? I'll start with you, Daniel.
Well, in the stricter sense for impact investing, we define the impact measurements, the KPIs, in line with the IFSC rules, how you should do that. But that does not always easily apply to, let's say, more liquid asset classes, because it just doesn't work for very diversified portfolios. So we will have to define, for now at least, our own standards. The European Commission is, of course, on a way to publish a taxonomy around this as well, which maybe at one point we can use, but I don't think they are at the point where this is already the case, that you can just implement that. What is important for us and for me is that we are very transparent about it. We also just heard from you. As owners, you want to look into it and you want to make your own judgment call if this is actually what you wanted and what you meant when you allocated some asset towards SDGs. And I think that's what we have to offer to our clients. And that's also why we decided, for instance, just last month that in Credit Suisse Asset Management, we will fully cover everything we do with ESG and impact reporting.
Yeah. How do you look at that, Tom?
I mean, similar. It's I would sort of echo really what Daniel said. We are looking, and I have a dedicated analyst who's really analysing the whole portfolio. We don't just look at what is clearly an impact investment. For example, we're invested in a waste to energy fund in the US, which is clearly an impact fund. Similarly, we've got a private equity investment in the northeast of England that is an impact private equity fund where we're invested. But we also look at, in more general funds at the impact investments within them, and we're actually finding that there's really quite a lot. So we're taking a total portfolio approach to measuring our impact, and we're hoping to start reporting on that next year.
Claudia, what are you doing then?
Yeah, so given the size of our portfolio, we're quite humble in terms of what we can and can't measure. So we look quite clearly at the impact of our engagements. So to what extent have the desired outcomes been achieved? Then we have a carbon footprint reduction target for our listed equity portfolio. And that is nicely measurable. And then through our approach to the SDGs, we actually measure the contribution that we make based on financial indicators and how much we have invested. And that can also be outcomes measurements. But for us, we found that actually it's not that easy to measure it across a large portfolio and across all asset classes. And we're also increasingly using AI-based technology to help us in that process, to actually be able to troll through the reams of data. So that's where we see things are being headed. And I probably shouldn't forget also in terms of voting and corporate governance engagements, we also we look at the change over time at companies and what our votes against and our discussions have achieved.
Great. We have another poll for the audience really quick, and then we're going to go to some audience questions, but we wanted to see where do you think ESG and impact investing will have the biggest impact? Poll load in just a couple seconds. And I want to ask the panelists too, while everybody's voting, where are you seeing the biggest opportunity right now? We have the questions are aging infrastructure, energy transition, affordable housing, healthcare, emerging markets. where are you seeing, just lightning round, the best opportunity, and then we'll go to some questions from the audience.
We're active in all of them, but we are seeing probably the most opportunity in the energy transition space, but also the healthcare space. So similar to the audience, but probably a bit more opportunity in the healthcare space too.
Yeah, we are building out our infrastructure investments and continuing to do so because we see good investments there. Some of them, of course, also linked to the energy transition, and then likewise in real estate.
Are you doing climate adaptation also?
Yeah.
Okay.
I would support that and maybe add two more thoughts. One is healthcare, but combined with emerging markets, where we see huge demand and also great potential because there's hundreds of millions of people which are underserved at the bottom of the pyramid. And we have now access on the private equity side to very interesting solutions that deliver health services and also access to medication to these people at a very affordable price. So I think it's a really good combination. I worked in development cooperation before, and the most successful projects are always those which are financially viable because they multiply and they grow. So if we can combine that, that's ideal. And another topic which I don't find on that list is sustainable consumer strategies, because the society is really now also very alert about consumption, about waste production, about where their food comes from, about the packaging they're using, what transportation they are using. And I believe that's also a very interesting area where we can have an impact and we'll find a lot of interest from investors and consumers alike.
So I have a few questions from the audience. That was a great lightning round. Tom, this one's to you. Do you see any sectors where there's an absence of genuine ESG strategies out there?
I wouldn't say there's any sectors where there's a complete absence of ESG. I mean, I think there's certainly areas where ESG and responsible investment penetration is less. Hedge funds might be an example of that, but actually we've worked with APG on how to get ESG into hedge funds, and that's been a successful collaboration actually. And we're seeing those barriers broken down and change happening. Another area where it's very hard, the VC market, trying to get very successful VC managers to do anything different than what they want. I mean, it's a reverse marketing process if you want to get access to the very best VC managers. It's not compared to the normal process. But even there, we're seeing, some change with ESG wording incorporated into their documentation, etc. So I would say I would say there's no areas where it's completely absent in our experience. There are areas where there is less penetration, but that is changing, and in some which echoes, if you like, the boom that we're seeing in the importance and the recognition of this, which is just great to see.
Yeah, I have a question for you, Claudia. That's a really interesting point. Is there a risk of greenwashing in some green bonds?
Yeah, so yes, one has to look very carefully at what does this green bond actually achieve? Is it about making an oil refinery more energy efficient, or is it actually about enabling the transition to the energy transition? So that's where you have to distinguish quite carefully, at least we think, as an investor.
Great. And for you, Daniel, one question. Are the SDGs enough for the long-term welfare of the planet? Are they going to be fast enough?
Oh, difficult question. Well, if you think back to the Millennium Development Goals we had before, it was actually quite amazing to see how well they were reached. And since 2015, we now have the SDGs. The topics are not completely new. They were maybe just framed in a little bit a different way, and they provide a reference system to describe what we are doing and measure what we are doing. So I think the topics will not disappear by 2030, but I'm quite optimistic that we will make a big step towards the SDGs by 2030, but then we'll still have to work on these topics. I'm a water engineer by training. Water will stay with us as a topic for the next 50, 80 years when I'm long gone. So,
Tom, 30 seconds, same question.
I think I'm also an optimist. But I think, you know, it's a real. We've had a lot of pronouncements from a lot of the oil, you know, the energy sector and the greenhouse, you know, emission companies, etc. But now we actually have to see it in practice. We have to actually witness and see the change. There's been a lot of talk about what we're going to do, but that actually has to happen. Right. And there, I think it's not going to be easy.
Right. The future is now. Well, thank you so much for a wonderful panel. Thank you to the audience.